You've worked hard to build your life. Maybe you're paying down the mortgage, or you've already crossed that milestone and you fully own your own home. You're saving for the future, investing wisely, maybe even managing a rental property or running your own business. Then, when you pass away, your estate gets hit with a tax bill so big that your loved ones have to sell the things you've built and your assets just to cover the taxes. This happens more often than people realize. Let's talk about why and what you can do to plan ahead. Hi, I'm Kemi Adefarakan, a lawyer and the founder of La Pro Law, where we help families and entrepreneurs with wills, trademarks, and business law. So last month, I spoke with a lady whose mother died about a year ago. She owned her own home, some investments, and a cottage where they spent lots of time together as a family. What she didn't realize that when her mother died, the Canada Revenue Agency, CRA, would treat her as though she had sold all her capital property immediately before death at fair market value. It's called a deemed disposition. On paper, the fair market value of her assets was over $1 million, which suddenly pushed her into a new tax bracket. She obviously hadn't planned for that, and her family wasn't prepared for that. They had to sell the cottage just to cover the taxes. That was really painful. In Canada, when someone passes away, the CRA assumes you've sold all your capital property, your home, your investment, your business at fair market value right before death. That means any increase in value from the time you bought those assets to the time you passed away is considered a capital gain. And here's the key part: 50% of that gain is taxable on your final return. So, for example, let's say you bought a stock portfolio for $20,000. At the time of your passing, it was worth $200,000. That's a $180,000 gain. And half of that, $90,000, becomes taxable income on your final tax return. Now, if you're in a 40% tax bracket, your estate could owe $36,000 in taxes just on one investment. And remember, this applies to all your capital property combined, your home, your business, your investments. So if your assets have appreciated significantly, your estate could owe tens or even hundreds of thousands of dollars in taxes before your beneficiaries ever receive a penny. That's why it's really important to plan, not just to have a will, but to have a strategy. So, first, make sure there's enough liquidity, cash, or easily sold as assets so your loved ones don't have to sell what you meant for them to keep. Consider using life insurance as a tool to offset taxes. Or if you're married, consider transferring assets, capital assets, to your spouse. In Canada, where capital property is transferred to a surviving spouse, the deemed proceeds at death are equal to the cost of the property, not its fair market value, meaning the tax on any gains is deferred until your spouse passes or sells the property. You can also explore trust options. So, if you've never thought about what happens to your assets after you're gone, it's time for you to start thinking about it. Let this be a reminder to plan now and not later. If you have any questions, please drop them in the comments. And if you found this video helpful, please like, subscribe, and share it with someone who needs to hear this. Until next time, take care of yourself. Bye.